So maybe you are looking into getting started investing in index funds, but you don't know what the difference is between one index fund to another. Well, in this video, I'm going to be sharing with you 5 things you should be considering when you're purchasing an index fund and 4 costs you should be aware of when choosing a fund. And also, I'm going to be giving you an entire example of how I research funds. So basically, like, you are going to be watching everything that I do, everything that I read, so that you can understand it and do it for yourself. Hey guys, welcome back to my channel. My name is Adrienne. I make videos every Monday on all things investing and personal finance. So if that's something you're interested in, definitely go ahead and click the subscribe button below. One thing Warren Buffett says is that for the average investor, investing in index funds is one of the smartest things you can do. And this is for a few reasons. 1, because they offer instant diversification. 2, they take out the guesswork in investing. 3, they charge low fees. And 4, no one can 100% correctly predict the market. And so this video is definitely for you beginner investors who are looking to understand what index funds to start investing in. And let me just tell you right now that this one is chock full of information, and I am pumped to share it with you guys because it's been one of my most requested videos. I have often said to know your investments well. So what I'm going to be talking about in this video, this is what I mean when I say know your investment. So I would suggest you get a pen and a notebook, but this video will always be available to you to use as a resource if you need it. First thing that you should be considering when you are purchasing an index fund is the company size and the classification. Funds are categorized in one of 3 buckets: large, mid, and small cap. Basically, that just means how large of a company it is. Small, medium, and large cap just means small, medium, and large companies. For example, a large cap stock would be Microsoft or Apple or Facebook. Those are very large companies who have a market value of over $10 billion. And medium cap stocks have a market value between $2 billion and $10 billion. And small cap stocks have a market value between $300 million and $2 billion. If you look at my portfolio, I mainly stay in the large cap. I think I have one fund that's a mid cap, but generally I personally stick around the large cap funds. The second thing you need to consider is if it's a value or a growth fund. So the difference between value and growth, I'm going to read the definition from Investopedia. A value fund is a fund that follows a value investing strategy and seeks to invest in stocks that are deemed to be undervalued in price based on fundamental characteristics. Whereas growth funds focus on growth investing, which focuses on emerging companies with high growth prospects. So neither are better than the other. It just depends on your investing style and what your priorities are. I would say some people are very strongly opinionated one way or another, but I wouldn't say one way or another for any one person, just because how I invest is going to be different than how you invest. It's also possible to purchase funds that are a blend of value and growth. The majority of the funds that I'm invested in are a blend between the two, and that's quite common. VTI is one of the most common blended funds of value and growth stocks. And my plan was to go over a list of all my investments, but I did an entire video on all of my investments and that hasn't changed. So I will link that down below and in a card up above. Also, if you check Morningstar, they place all funds in like this box that compares the size and if it's a value, blended, or growth fund. So you can see where in the box it lies. I'll try and put one in the video right here. The third thing that you want to consider is the geography of the fund you are investing in. Is it a domestic fund? Is it an international fund or foreign fund? The fourth thing you want to consider is the business sector or industry that the fund is heavily invested in. So there are funds that are specific to the industry that it's invested in. For example, there are funds that are just in technology. There are funds that are just in consumer goods. There are funds that are just in healthcare. Although they are diversified within each of those funds, they are heavily influenced and reliant on one sector. So for example, an index fund in the tech sector may have Apple, Facebook, PayPal, Microsoft. An index fund in the healthcare sector may have Merck, AbbVie, Abbott, United Healthcare, companies like that. An index fund that's invested in the consumer goods sector may be invested in Johnson & Johnson or Procter & Gamble, companies like that that produce goods. So a lot of times if something is impacted to an industry, that can overall affect that one index fund since that one index fund is so heavily invested in one industry. The fifth thing you'll want to look out for is the asset type. So there are funds funds that are just completely invested in stocks, so they're invested in companies. There are also companies that are just invested in bonds or commodities, so it's just good to be aware of what you're investing in. It's difficult to say if one is better than the other, and I don't want to say one is better than the other. For the average investor, the most important thing will be to stay diversified. So I'm giving you all of this information. All of this information is very important, but no one factor should make or break whether you purchase a fund or not. It's just good to know in the overall. Another thing you should ask yourself, what is its past performance? This won't exactly tell you what's going to happen in the future, but it is a good thing to look at. That's only one thing to consider. I wouldn't say you should make your decision based on if something has gone up in the past. Okay, and now for the 4 costs that you need to be aware of before purchasing an index fund. Index funds are typically cheaper to own because they aren't actively managed like a mutual fund would be. However, there are administrative costs that differ depending on what financial institution you're using or which one you're buying from. 2 funds may have the exact same index. For example, 2 funds may both follow the S&P 500, but they may have wildly different management fees depending on what you're purchasing from. So the first cost you should be aware of is the investment minimum. I haven't seen this too much, but sometimes funds have a minimum investment you need in order to basically buy in to invest in that fund. This is going to be the smallest amount of money that an investor needs in order to purchase that fund. Sometimes it's $500. I've seen $1,000. It's not super common, but it is there and it's good for you to be aware of. The second thing is the account minimum. This would be the amount that you need to have or maintain in order to open an account with a specific brokerage firm. The next 2 costs are probably the most important that you're going to need to know. The first one is the expense ratio. So the expense ratio is the annual fee that funds charge the shareholders. And it's shown as a ratio because it's the percentage of assets that are deducted. You can think of this one as sort of like the administrative costs of owning the fund. And from what I have read, the average expense ratio for an index fund is around 0.2%. It can be as low as 0.02%. An expense ratio is going to be higher for a mutual fund since it's actively managed. And the second cost that you should really be aware of is the tax cost ratio. So the tax cost ratio is how much of a fund's annual return is reduced by taxes. So these are taxes that the investor must pay on dividends, distributions, and any capital gains returned during the year. And that is for a taxable account. So that would be for a normal brokerage account. But in a tax exempt account, so a Roth account like a Roth IRA or a Roth 401k, you never have to pay taxes on the gains that you make. But for a tax deferred account, so like a traditional IRA or a traditional 401k, the taxes you pay are deferred, so you pay them upon distribution when you are in the age of retirement. Another term that you may have heard this said as is tax efficiency. So tax efficiency is the same as tax cost ratio. For example, if a fund has a lower tax cost ratio than another fund, it may be considered more tax efficient. And I want to say that none of these expenses are necessarily bad, and just because something has a higher fee in something doesn't necessarily mean you shouldn't buy it. It's just one thing to consider in like the bigger picture. And so now I'm going to move you guys from camera mode to computer screen mode and show you exactly how you can research everything I just talked about for the index funds that you are looking to research. So for this example, I'm going to be using QQQ, which is an Invesco trust. I'm using Yahoo Finance. I think it's very user friendly and it is free, so you don't have to pay for it. But if you look on Yahoo Finance, go under profile and under category, you can see that QQQ is a large growth fund. If you go to holdings on the left side of the screen, you can see a basic summary of the fund, and you can see that this fund tracks the NASDAQ. If you look here on the left, you can actually learn a lot about the fund through these numbers. Here where it says overall portfolio composition, you can see that it is 100% invested in stocks. And also under this sector weightings, it's also pretty heavily invested in the tech sector. And also if you go down a little bit more, you can see the top 10 holdings within the fund. So these are the top 10 companies that this fund is invested in. I'm not quite sure where to look for if there is an investment minimum or an account minimum here on Yahoo Finance, but that's something that you can just Google if you want to find that out. And also if you go to summary, you can find the expense ratio. So the expense ratio here is 0.2%, and the tax cost ratio isn't on Yahoo Finance either, but we we can look that up. So the tax cost ratio for QQQ is 0.3%. And we can also, if we go back to Yahoo Finance, you can check out the long-term track record of the funds. This little box right here shows the value of it throughout today, which is December 2nd. But you can also do 5 days, 1 month, 6 months, the year to date, which you can see it dropped when COVID hit. And then also since last December 2nd, the last 5 years, and also the max. You can see how the value of the fund has changed since the fund was created. What are you supposed to look for in an index fund?
What is it? Index tracking. I'd look at the specific stocks to make sure I was okay with them. And then of course the cost. Funds are supposed to be, or ETFs or whatever, are supposed to be cheap, because they're not supposed to trade other than, you know, when people redeem. And if it's a bigger one, they can be more efficient, because what they'll do is, rather than go through a broker, they can trade amongst the people that are buying and selling them. So they don't actually have to sell the stock, but they have to monitor it and get it and balance it every day.
And that is how I research funds. So question of the day, what fund are you planning on researching next? And also future Adrienne has some announcements, so I will let her take it away. So the first announcement I wanted to let you guys know is that I did do a podcast last week. It is called the Rambling Mind Podcast, and we had a really, really awesome conversation about finances.
From what I've read, millennials who find themselves like regretting their home buying purchases because they feel like they're in the life stage where they need to make the next step and buy a house.
So if you want to check that out, I will link it down below. I also wanted to announce this week's giveaway winner. This week's giveaway winner is Joshua Kermy. Congratulations. I, at this point, will have emailed you. This week's prize was one of the books that I mentioned in my last video. If you haven't already, I'm doing a giveaway every week in December, just as a thank you to you guys. And so next week's prize is a $25 gift card. To enter the giveaway, all you have to do is subscribe to my YouTube channel and complete the form down below. If you've already filled out the form, you don't have to do it again. And I will have the form linked in the description and also in the comments. Thank you guys for checking out my video. And as always, don't forget to hit the like button and subscribe down below for more videos like this. And I will catch you guys next Monday. Bye guys. I hope you guys got a snack because I'm hungry. I have a friend coming. Oreo, this is not for you. Do you want to learn how to invest in index funds? No, I didn't think so. I don't have any more Oreo.